All right, let's dive right into Lang LaSalle's Q2 2025 earnings. JLL didn't just have a good quarter, they showed us a strategy that is absolutely leaving the rest of the real estate market in the dust. So let's break it all down.
First things first, let's get some perspective here. Over the last year, JLL's total return is a whopping 21%. Now, look at the broader real estate sector, the IOR ETF. It's actually down. That kind of massive gap really makes you wonder, what exactly is JLL doing so right?
Well, it all starts with a classic beat and raise. I mean, with all the noise out there, geopolitics, policy debates, you name it, JLL just powered right through and delivered a really, really strong quarter. Okay, let's get into the numbers. Adjusted EPS, it came in at $3.30, beating Wall Street's expectations by 3%. Revenue hit $6.25 billion. And get this, that's their fifth straight quarter of double-digit growth in local currency. That's just plain impressive, no matter what the market's doing. And it's not just about the top line. The operational strength is there too. Free cash flow surged 22% compared to last year. That tells you they are managing their cash incredibly well. It's a sign of a really healthy, efficient business. So, how are they doing it? How are they pulling this off? Well, it really comes down to this core strategy that management keeps talking about, the two-engine model. Here's the idea, and it's pretty smart. One engine is what they call resilient. Think of steady, fee-based businesses, like managing corporate offices, stuff that brings in cash flow, rain or shine. The other engine is transactional. These are your more cyclical businesses like big property sales and leasing that have huge upside when the market is hot. So you've got stability from one side and explosive growth potential from the other. And in Q2, man, both of those engines were absolutely firing on all cylinders. You had project management from that resilient side, growing a massive 22%. At the same time, debt advisory, a transactional business, just surged 27%. This is the model working exactly like it's supposed to. And if we peek inside that resilient engine, workplace management was up around 10%, thanks to new client wins. But the real story here is that 22% jump in project management. That's a direct payoff from their big strategic decision to unify that business on a global scale. And wow, is that decision paying off? So, with results like these, what was the tone from the executive team on the call? In a single word, confident. Management sounded really bullish, and not just about the last 3 months, but about where things are headed. The CEO, Christian Ulbrich, I think he just nailed it. He basically said that clients are getting used to all the chaos in the world. They're tuning out the macro drama, accepting the noise, and just getting back to business. And for JLL, that's a huge tailwind. And look, they backed up that talk with real action. They raised their full-year guidance for adjusted EBITDA. That's a massive vote of confidence. And while they're still focused on investing in the business, they also said they're going to ramp up share buybacks. And with a super strong balance sheet at just 1.2 times net leverage, they've absolutely got the financial muscle to do it. Now, it wasn't all perfect. Management was upfront about the challenges. That macro noise has put some of the really massive multi-billion-dollar deals on hold for now. And on the operational side, they took a $14 million hit on a Fannie Mae portfolio and are shaking up their property management contracts, which might cause a little short-term disruption. Okay, so you have this mix of great results, confident guidance, but a few acknowledged headwinds. So the big question is, how did Wall Street take the news? It's actually a pretty fascinating story for the stock that day. Before the market opened, it was sitting around $272. Then, right at the opening bell, it dipped, down about 1.2%. But as the day went on, investors clearly dug into the report, and the stock started climbing, eventually closing in the green, up almost a full percent. It's like the market needed a minute to digest everything and decided it really liked what it saw. And here's the kicker. Trading volume was insane. It shot up to nearly double its normal average. This wasn't a quiet move. Big money was definitely making decisions. And by the end of the day, the bulls had clearly won. So that brings us to our final take. After sifting through the numbers, listening to management, and watching the market's reaction, here is our forward-looking thesis from us here at Talk Tickers. Our rating on JLL is a confident outperform. We think the stock is going to continue to beat the broader market. And here's exactly why.
That two-engine model is working beautifully, giving them both safety and growth. Management's confidence is just off the charts, and they're backing it up with a higher forecast and more buybacks. Their balance sheet is rock solid, which gives them tons of options. And at the end of the day, you just can't argue with this track record of crushing the sector.
Now, for our trade idea, we're calling this one the office obsolescence pair trade. The whole idea is based on this flight to quality we're seeing in office buildings. Since nobody's building new ones, owners have to upgrade their old buildings or they'll become worthless. So the trade is this. You go long JLL, because they're the ones getting paid to do all these renovation projects. At the same time, you go short a handful of smaller office REITs that are stuck with old, tired buildings and don't have the cash to fix them up. It's a way to bet on JLL winning while the weaker players get left behind.
Which really leaves us with one critical question to think about. As this race to upgrade buildings gets faster and faster, who's going to be left holding the keys to the ones that just can't be saved?
This is not financial advice.